We've heard a lot today about stress testing. So our final panel session is going to be on what should be the state of the art for stress testing. And we can think of no better chair for this session than Dr. Craig Manfold, who is the stress testing lead at HSBC. Yes. We're just going to move we thought perhaps having the chairs in the one on that.
I think I had an issue on this one. Well, the good news is I don't intend to talk too long. I'd like to thank the Institute for inviting me to moderate this session. It was a pleasure to be back in Cambridge. I'd also like to thank the panel for agreeing to take part. We have Alexander Petrov, who's a partner for McKinsey & Company. And we have Keith Church, who's a director in Oxford Economics. As you were discussing this morning, looking at the macro modelling and scenarios. And we have Marwa Haman, who's the executive director of the Cambridge Master of Finance program here in Cambridge. As I said, I don't intend to speak for too long. I've had 15 years or so experience in various investment banks and so I've seen a lot of change in terms of the regulatory environment that's currently being imposed. Some of it good, some of it bad. One of the biggest changes I think which has happened in the last few years has been the oversight and governance around models and the use of models within investment banks. And one of the key aspects of that is the use of models for stress testing. So I think the response of investment banks in particular over the last few years to the various regulatory regimes that they've been subjected to has been haphazard, to say the least. It's been a process of learning on the job and trying to do the best that is absolutely possible while meeting the both the spirit and the intention of the regulatory requirements. So with that in mind, what I would do is like to hand over to the panel to ask the question, in your view, what is the state of the art in stress testing? Alexander, would you?
Maybe if I can start, and I will touch on your point. I myself was a modeler when I started my career, so for 4 or 5 years I developed structured finance models and in investment banking, and then moved later to consulting. So what I've seen over the last 5 years is indeed when the industry was first hit with the stress testing requests, it was pretty much, okay, let's figure out how we do that. And the modeling infrastructure that was used then and had been used since then started really outside the core banking systems. It was in all the cases that I know, in the top 20 banks in Europe and in the US a few years back, it started with something that was kind of either adapting models that were already there or developing something totally separate. So that is transitioning, right? And depending on the institution, it's at the various stages of development. For me, again, talking about models, the end state, to answer your question of stress testing, is when these models are implemented and are made core of the banking infrastructure. Whenever a stress test becomes a core risk process of the organization, subject to similar things and similar governance models, organization, and staffing, if you want, as the other more historical, more robust processes, risk processes, that's the end game. Where are we from now? Depending again on the organizations, it's between 2 years and 4 or 5 years, in my view. At least. I'm paid to be optimistic.
Keith, can I address the question to you?
Okay, so maybe I should have gone first because I'm at an early stage of the stress testing process in some ways. I'm getting the economic assumptions from the EBA or from the PRA. And I think for it to be state of the art, we need to, those organisations have work to do as well in terms of what do they actually want these scenarios to be tested. Do they want these to be, I know stress tests aren't about forecasts, but sometimes the assumptions you get, and you look at them as an economist, you think, well, is that really likely to happen? Or is that the thing, in your position, I wouldn't be testing that. I can think of a couple of examples, like the PRA about 2 or 3 years ago had a high inflation, high interest rates, high wage growth scenario, a bit like the inflationary scenario we had earlier on, but probably not the biggest risk that was facing the UK. So there was an element of, do we just throw the worst things into these scenarios we possibly can? In the end, you don't need a model to do that. You can just look at everybody's book and say, right, what would hurt you the most, even if the shocks aren't really correlated with each other. So some combinations of events are quite unlikely, but if we're doing a stress test, we need to worry about that. And I would say at least you want to be able to use your stress test for business planning purposes as well as just looking at seeing where you pass the capital test. So if you really want to, state of the art for me would be integrating the stress test into the business as well. So I got a little bit of experience in the business, and that's sort of the holy grail from there. I mean, if I look at the EBA stress test from 2014, the critical days, the test was all about problems in China and problems in Asia, and this is where the test of the European banking system was coming from. It ignored Greece and the fact that Greece was likely to default, and it ignored the fact that deflation was on the doorstep as well. So it's just a question about, you know, was this scenario a one that was picked to make sure a few banks failed but not all of them failed, and they had time to get there? Yeah, that's a provocative thought, but it does seem odd that you wouldn't test Greece or default, the sort of scenario about countries leaving the Eurozone that we saw earlier in the presentation. I think modelling is really interesting. What worries, if I was a bank analyst, I wanted to compare the results of this stress test, I would be worried about the bank models that are used in these stress tests are proprietary to those banks. There's not much transparency. They have different modelling approaches within a, you have to fit into a certain framework, but there's not much transparency there, or should there be more there? And also, a final thought, the governance side, which I agree with, which is coming in our direction in spades at the moment in terms of governance of our model, whether these stress tests make allowance for the interdependencies of the bank, because everybody's given the same assumptions, and they, in certain circumstances, make assumptions about the management actions they could take, like withdrawing from the market, but actually not everybody can withdraw from the market, or there will be no market. So it's whether the system as a whole, the stress test, if the stress test is state of the art, it will capture these interlinkages as well as the stress on the individual organisation.
So picking up on Keith's point, I just by way of background, I'm a credit risk manager by background, but I did do a little bit of time in market risk and sovereign risk, and I can draw some analogies here. But to Keith's point, I guess when you're looking at kind of more idiosyncratic stress tests, you really want to look at factors that are relevant to your portfolio. And I think one key thing that it's almost like the stress test becomes an end in its own, especially the regulatory enforced stress tests, where you have to complete it, you have to come up with what your extra capital requirement would be to offset the risk that the stress test tells you will generate under the scenario. But arguably, having covered a portfolio of counterparties myself, I found it very difficult to actually associate the macro stress test requirements or indicators that were provided by the regulators to the actual, what happens on the ground with your actual counterparties. So how do you translate a macro scenario where you're supposed to look at a stock market crash or another housing bubble or GDP stalling to X% to what actually happens to your individual clients? And I think the key issue is that ultimately it all boils down to how much extra capital the banks have to set aside. But what a lot of people who get involved in stress tests lose sight of, and that's where the state of the art or maybe the best practices can be built in, is that ultimately it has to do with what happens to your risk-weighted assets. And when you look at any typical banking institution with a balance sheet, so with a commercial lending arm, credit risk is ultimately the largest risk they take and the biggest proportion of their risk-weighted assets. And ultimately, when you're trying to work out what your risk-weighted assets will be, it's your exposure multiplied by your counterparty risk. And a proxy for that is your probability of default on that client and your loss given default, which is going to be your recovery or the inverse of your recovery. And it's really looking at what happens to the probability of default at counterparty level, and then accumulating that across the portfolio to come up with a figure, i.e. a portfolio risk rating, which would then translate into that capital amount. And I think that's where things kind of get a little lost in translation with those macro, systemic, enforced regulatory stress tests. So what we used to do at Citi, I worked at Citigroup for about 10 years and over 2 stints. And what we used to do was kind of layer in a more granular approach where we did what we call rapid portfolio reviews. So we would come up with stress factors that would basically be more relevant to our client set. So Citi broke up the world into kind of products and regions and industries. So as a risk measure, my coverage was utilities, and we'd look at factors that impacted our utilities portfolio. So they may be broad issues like the Eurozone crisis, 2 issues we were discussing earlier, Craig and I, about nuclear incidents like the Fukushima incident back in 2010-11, and the impact that would have on our portfolio. And arguably, those were more informative to the work we were doing.
So would you advocate that regulators prescribe bespoke stress tests institution?
Well, I guess
that sounds like a similar view to what you were discussing, Keith.
Well, the Bank of England are moving in that direction, of course, because they're going to have a biannual exploratory scenario, which not all organisations will do, where it will probe at different parts of where there is a exposure.
Do you think it was bespoke enough?
Well, I don't see that they're going to make only one institution do it, so probably it will be quite large. But I think companies are expected to do their own idiosyncratic scenarios as part of showing that they use stress testing. So I'm slightly off my comfort zone here, but my understanding is that you are supposed to show that you use stress testing as part of your business planning process. Just where I worked before, there was a very large Scottish portfolio, so you can imagine that when there was talk about Scotland becoming independent, that was quite a hot topic when we suddenly realised that actually Scotland became independent, had its own currency, then all the people that held mortgages in Scotland would be paid in Scottish pounds, which would devalue no doubt overnight 25% against sterling, and then not have enough money to pay their mortgages potentially, because the debt was still being in sterling. So I do think that it's up to organisations really to take the lead on that. And if you're doing state-of-the-art stress testing, then you should be looking at your own weaknesses.
And you rather like to BAU as you would advocate.
Yes, I think there's a fair point about the fact that building stress testing infrastructure is not cheap, right? The stress testing budget of the banks run into many zeros, right? I mean, they're pretty ugly to look at. So the question is, how can the banks make most use of that? And I think the point about using it in the business, on the ongoing business, is a very valid one. So if you are, and I think the credit models is one piece that we have used in businesses for a long time, but the income side of the models, right, the PPNR, the PBO as it's called in the UK, so the profit and loss balance sheet modeling, that's something very interesting that it's only now ramping up here in Europe. And that is something that businesses are definitely interested in, and they should be interested for doing better decisions and strategic guidance. And the ultimate, where it really becomes a kind of end state for me is when it's combined a proper capital planning / stress testing is run across the bank on the same infrastructure, maybe at different times in the year on a different calendar, but pretty much using the same infrastructure and governance. So you stop having stress testing committees and output committees and so on, but it's one capital management unit.
But how would that be reconciled when you have, say, 30 different stress tests globally that a global investment bank might be subjected to in the course of 1 year? Speaking as somebody who works in a global bank,
yes.
I can see that problem. And do you have any views on this?
I have a view. It will not be easy. We have looked through that. It's not so there's twofold answer to that. The basic principles of how you do stress tests should be the same and should go through the organization. The individual specificities, especially taking CCAR versus PRA versus the ECB, but layering Hong Kong, layering the Australia, layering the Palestinian Investment Authority, if you want, right? I mean, it's quite a lot. So it cannot be standardized to a level that would work from my perspective.
I think given the volume of stress tests that are required, I guess maybe looking at them from more of a functional perspective, so maybe the market risks, related stress tests. Arguably, market risk is easier to model, and the variables underneath price liquidity risk, which essentially is what you're measuring for under a market risk-driven stress test, are easier to kind of build out into a Monte Carlo simulation. So perhaps the stress tests that are more geared towards that end, the product spectrum, could be aggregated into one global stress test that kind of picks up all different pieces. And maybe the credit kind of related stress tests could be aggregated too. I mean, it's easier said than done. I think you just have to build out a framework that kind of captures all the different variables and maps them in such a way that it churns out a number, whether it's a VAR number or a shift in the portfolio risk rating that I was saying earlier with credit risk. But it's really, I think in a way, the banks are very siloed. I guess any organization is very siloed, and there's lots of data there, but harnessing all that data into a model or a series of models that actually picks out all the different indicators and, informs management in terms of, what those risk factors actually mean and what management action plans they need to take as a function of is the challenge. But you think in this day and age with the amount of technology and, another point I wanted to raise was big data. I mean, how could that kind of be harnessed as well to better inform some of these decision-making processes? But I think, the banks have to invest in a technology in which, they have to build out an algorithm, and it is doable. I mean, one area that I do research and I'm writing a case study on right now is credit analytics and developments in credit analytics by harnessing the power of big data. And it's doable. There are companies out there that have actually built out algorithms that pick out, up to 20,000 data points to actually come up with a decision, a credit lending decision on counterparties within literally, less than a minute. So the technology is there, it's doable, but it's just a matter of integrating it and breaking through the risk silos within the financial institutions and things.
The problem we have then is that you need to fill that in 20 different templates as required by the regulators. I think that's what big data fails.
Yeah.
That's on Kinsey. Joking aside. There was an interesting, slightly moving on from the analytics side. There was a very interesting point made earlier that when the regulators are mandating banks to do these stress tests, the banks are essentially doing them in isolation. And each bank is saying, okay, well this applies to my portfolio and this is the impact of my portfolio. But of course, as we've heard all day, network effect, contagion effects. Is it feasible that the results of these stress tests are reliable given the fact that there will be contagion effects and knock-on effects? Do you kind of have any views on that? Yes?
You're touching a very soft point because I worked for Lehman for 10 years and I remember that the verdict was Lehman's bankruptcy will be a contained one because it's only like a 20 billion thing, right, and it would not have an effect on the global financials. So unfortunately that didn't turn to be true. I think that's the Enchanted Waters, and that's the point where I honestly believe we need more research and thinking on. I haven't seen convincingly kind of evidence and thinking that is good enough. I'm afraid to say.
Who should be taking the lead to do that research, to do that individual thinking? Regulators, banks,
Centers like this one.
consultants.
Good question.
Of course, central banks have the biggest interests, regulators. And I think we know. I think there are models out there. The Ramsey model is in the banking industry where they take back the states who are running through their own stress testing engines. So they must think about those interactions when they do that. They see all the data, so they're in a position to actually think about those issues, join the dots, whereas nobody else really is.
Okay, moving on.
But a well-functioning, a state-of-the-art stress test for the system, in my view, would mean that you have such a model somewhere, maybe the central bank is the right repository, that once the institutions run the individual stress test, then there is an adjustment, right? So it's not, okay, I passed the code. It's not about passing or failing. It's, okay, this is my risk profile as an institution. Okay, now the central bank layers in everything because they have all the others, and they have to see the second and third order effect for the system. And then we return if you want a more risky profile or a less risky profile.
Okay, and then does that extend to just national regulators? Because most banks are global in nature, and you can't contain contagion across borders. Would you see a situation where regulators globally would work together to undertake that level of detailed analysis of the financial system? To anyone?
Well, I guess even though we can more sort of, bottom-up, idiosyncratic-driven stress tests or scenarios, I think one area where, the virtues of having a system-wide or regulatory-driven scenario would be contagion. Because I guess if you identify one or two or three factors which have a global kind of outreach to them, then arguably that would capture the global linkages and spillover effects outside of, national boundaries. So that could potentially help. One other thought I've had also is, contagion can relate to the counterparty network effect as per Andrew's slide, I think, earlier. So, the developments in having central clearing kind of systems embedded within, the financial industry, that does help contain that risk, and at least it helps kind of pull in data in terms of who the different counterparties are, what the linkages are, if they're all going through a central clearing system. So that could potentially be another source of data, or perhaps those central clearers could be party to those stress tests in terms of they see all the different legs of the transactions that are clearing. So that could potentially be, another input into the wider stress test.
I think the use of CCPs is interesting in that financial network. So moving on to an issue that's close to my own particular heart and the work I do. We have finite resources in the bank to do a particular job, whether it's stress testing or any other regulatory requirements. So we have to focus our resources most effectively where the most material model risks exist. Do you have any views on how you can assess that consistently across a whole institution? So an institution that spans both investment banking, retail banking, commercial, private banking. Again, do the panel have any thoughts on technologies for consistent measurement of materiality across multiple asset classes?
It's an advanced question. So what I have seen is a fairly basic analytics in terms of what has been applied. I think there needs to be prioritization because resources are always finite. As you said, that the banks are looking to achieve the biggest balance sheet coverage, but what I have seen is it's done dismantle, meaning you take the mortgages as a business and then you ask, okay, which models cover 80% or 70% of my mortgage? I do the same for credit cards, auto loans, then I move to trading, the investment banking part, and I look at that. I think starting to optimize globally is probably too big of a task. Some optimization needs to be done, but again, I don't have a good view, and what I have seen is more like basic analytics rather than Star Wars.
Certainly helpful.
Big one in effect.
I mean, I can just add, I don't have an answer to that, but what I could say is that, again, just thinking back at the crisis, one of the key issues was that, risk was siloed, so to the point you're making, the risk wasn't aggregated in any way. The only, I don't even want to call it a model, but the only framework I've seen that kind of pulls the different businesses together was a tool that we used to use at Citi way back. It was kind of in the early 2000s, so believe it or not, 15 years ago, there was a tool that was actually fairly simple, arguably a little heuristic in terms of how it's set up. But it was called scenario planning. I'm not sure if you guys are familiar with it, but it's kind of a system of leading and lagging indicators. So lagging indicators, i.e. sort of economic data, political tripwires, data that is basically giving you an indication as to where the economy is heading, or the geopolitical space is heading. And then alongside that, you have a set of leading indicators, market indicators, to the point I think Mark was making earlier, So things like, the repo rate, CDS, overnight lending rates, so data you can pull every day. And then, it was kind of a stoplight color-coded system where what combination of, leading and lagging indicators would mean for various scenarios unfolding, depending on various levels of adversity. Now, what I'm building up to is to your point about how the different businesses can be integrated. The latter part of that model was basically a set of what we call management action plans or management action triggers. So if a certain combination of triggers and tripwires were hit, then we knew exactly what the corporate bank would need to do, what the treasury guys would need to do, and what, let's say, the consumer bank would need to do. So, on the corporate banking side, do we start running more of those rapid portfolio reviews? Do we start looking at maybe CDS cover for some of our exposure, selling down into our exposure? On the treasury side, do they start kind of reviewing their interbank lending kind of practices, or do they call daily alcohol meetings perhaps to kind of revisit and see what the situation is?
And then becoming very much expert judgment.
That was the big downside, I think, with scenario planning, and perhaps why it's not necessarily kind of taken off and has fizzled away. It was used, I must say, it was largely used in terms of sovereign risk management, so looking at cross-border and country risk management limits and so on. And the problem is it was very difficult to model. It was all judgment-based. So the weightings for the different scenarios, what number of triggers and tripwires would have to be hit for a certain scenario to deem to have materialized, was all down to judgment. And that was the difficulty. And I guess to your point, I think it's very difficult to model a lot and pull in all of these different data factors into one framework that then informs management. I mean, again, I'm contradicting myself a little bit, and like I was saying, with the technology in this day and age, surely it's doable. It's just perhaps a massive task because of the different silos that sit underneath this framework.
Perhaps the problem is the complexity of data that's available and being able to interpret it and understand what the message is telling you.
Yeah, I think it's identifying what data points are relevant and what is actually modelable, for want of a better term.
Do the panel have any views on the choices of scenarios that the regulators describe? Could they be chosen differently?
I think what you want is consistency. I only worked in a bank for 6 years, but they were quite bad 6 years to pick, 2008 onwards. But one thing you're constantly asked to do is compare what was last year's stress test, what's this year's stress test, compare them, how's our balance sheet changed in between, are the results understandable? And regulators will ask that same question. But you need to explore different scenarios clearly because you can't stick to one. But you do need some consistency, and you probably want the regulator to have a consistent risk appetite. Because it becomes very if the regulator has is risk off and then risk on, then it becomes impossible to know for anybody to observe the health of to really abstract what the health of the bank actually is, because the scenario might vary in severity. So from that perspective, I think it's quite interesting what the Bank of England's doing in terms of it's moving to, I'm not sure it's a through the cycle approach to stress testing, but actually every year when the Bank of England, the PRA stress test is going to look at, from an economics point of view, this is where it will hit us, is going to look at the sort of cyclical scenario, but they're going to adjust the intensity of the cyclical scenario depending on where they think we are in the cycle. So if house prices have boomed over the next year, over the year in between the scenarios, then they'll have a bigger downturn in house prices, from what I understand. So if they think 30% is the peak to trough, and house prices go up 10% over a year, then it should be 40% in the stress test next year. So they're not changing their risk appetite, they think the risks are the same. I think that will help interpretation of the stress test and help banks plan for what they're going to do. Then they'll have the other scenarios which are always Socratic in the rest of the time. But actually then the stress test should become more predictable, at least for retail banks, because it will all be about the quality of the new business they've come and how the portfolios evolved over that year. So I think, you know, from that to me is moving towards state of the art, because the economic scenario will have some consistency to it, or the key economic scenario will have some consistency to it that will help comparison between, is the banking sector safer than it was a year ago, and asking those sort of questions, which should become easier if the goalposts start moving in terms of the scenario. But otherwise, I'll go back to my point at the start. As an economist, it's always nice to see a scenario that stacks up from the point of view of the narrative about whether it can actually, whether the assumptions are consistent, because if they are, it means it's been generated by a model rather than people just, you know, where a committee's got together and said, well, let's hit that really hard. Well, we'll hit that really hard at the same time, not really asking whether the two things are consistent. Again, does that matter? Is the objective just to, is the objective to have a realistic economic scenario, or is it just to stress the balance sheet as to an acceptable level?
Just as an added thought, again, going back to the point I was making about how banks kind of generally cut and slice their business along sort of industry lines. I'm just wondering, keep actually a question for you, if I may, in terms of, your thoughts on maybe more industry-driven stress tests, i.e., filtering down or funneling down from a macro scenario in terms of, GDP slowdown or housing buffer and whatnot, into kind of more specific risks that affect certain industries. For example, with the oil price being where it is right now, there will be some industries that will benefit from that, and other industries that will take a massive hit. Commodities, same thing. We've seen a massive commodity cycle. Again, the metals and mining companies will be impacted in some way. Other users of commodities will benefit. So I just wonder whether kind of more industry focused, because that's what the banks do internally, but with the sheer volume of regulatory-driven macro stress tests, there really isn't enough manpower capacity internally to run, arguably, there's more kind of informative, more beneficial stress tests internally. So I wonder if the regulators would kind of take that view in terms of maybe introducing industry-driven stress tests.
I'm sure they will when it comes to the idiosyncratic, the exploratory scenario they're going to do every 2 years. That's something, I should imagine the first one's going to be more of a regional view. From an Oxford economics point of view, we have an industry model, so we can ripple down macro scenarios through the industry model, through the using input-output tables, and then onto cities actually. But my question is, are banks geared up to actually go down to that level themselves? Now I'm thinking about the retail banks because I'm more familiar with that. Clearly, if you look at some banks' books, they've got pockets of lending in particular places that they might be quite. Well, during the downturn, I seem to remember going along to Macabre meetings of risk managers who would discuss how many flats have you got in this residential block in Leeds and things like that. So you could, if you really state of the art, you could say we're very the public sector is going to get reduced a lot in this country. We're cutting the local government. How's that going to affect our book? How many public sector workers do we have on book? But I'm not sure that people could really answer those questions in their stress testing models very well. But it's possible so it might be it's easier to do for the macro level than it is to do at the portfolio level. But I'm sure the question will be asked.
Does anyone have any questions? Please go ahead.
Yeah, my question is related to microprudential and macroprudential stress testing. So you mostly, actually exclusively talking about microprudential stress testing. So my question is, does the panel recognize that there's a need for microprudential stress testing? And if so, should it be done, or how could we generate an incentive for financial institutions to integrate macroprudential stress testing in their risk strategies?
I'm not sure I understand the question, Alan. So
Okay.
can you define that? Is it micro or macro that is done and what should be done?
For the definition, microprudential stress testing is basically the assumption that when a single institution is safe, then the entire system is safe.
if I understand well, how would an individual institution be able to run that? How would it get the data?
Well, we do that. We get the data, and then I think individual institutions would get the data as well.
The individual institutions can get data on other individual institutions.
Of course.
Sure. Especially the public data that you can get is not going to be granular enough to make any meaningful conclusions on.
Well, the banking model is using public data, and it's macro-prudential stress test.
Yeah, I guess my answer was a way to say that I don't know, that I don't have a perspective on this question. But for me, again, it leads back to a single event versus systemic-wide analysis, which for me, again, is best done at the regulators level, not at the private institution level, or at various research centers around, rather than the bank itself. I see very, again, I think there is, banks right now has been so battered by regulation that unfortunately they're trying to answer kind of the exam question as they go along. So the degrees of freedom and the desire to do things over and above the regulation is very limited just because the regulation is so encompassing. And I think that will run for a little bit until, or more, until that process is stabilized and at which level you can get them more engaged for further questions. Other perspectives, thoughts?
So, just a comment really. I mean, I'm an insurance guy. It's always been interesting as to bankers actually find it difficult to build a whole company model, and I've been trying for 15 years to do it in insurance. Now you could argue about our business is simpler. We also have issues around correlation, dependency on risk drivers. But for me, the value of building a model, trying to build a model, is actually understanding the assumptions you have. I'm a great believer that models are driven by assumption, not data. There's not a one-one correlation between data and assumption. You have the best data in the world and lousy models, particularly if you pick the wrong distribution or something like that. So I mean, I was quite interested to hear what you were saying, Marla, about actually where you have a model, oh, it's got expert opinion in it. For me, that's not a bad thing. If you have expert opinion in a model, at least they're forced to articulate the assumptions which they're currently making. And those assumptions then held out to light and they can be challenged. People can argue about them, perhaps challenge them with data. So is that necessarily a bad thing? Would it be a good idea just to encourage that type of process? And kind of trying to build a cross-company model, even if it's very difficult.
I think if you ask the American regulator, will tell you that's a very bad idea. They're trying to push everything from judgmental to a model statistical-based relationship. They even want non-model models in the case of where you don't have a robust modeling relationship. And the whole idea is not that there is something wrong in the expert judgment, but its applicability over cycles and in various formats is very, the consistency is very low. Then you really depend on the expert. And I think insurance, for that matter, is very used to that, right? Because there's a lot of underwriting that goes, especially in the more specialty cases. Again, I'm not an insurance kind of guy, that's an outside perspective. But I think on banking, it's something that is not discouraged, but it's less and less encouraged. Maybe I don't know, maybe you have a perspective, Mark. You have a guess from the US.
The US regulators are moving towards what is loosely called data-driven regulation, and it's not a substitute for traditional supervision, it's a complement. But it's a recognition that you can identify patterns by doing this sort of cross-sectional comparison with consistent data that simply you can't get through expert observation of the supervisors on the ground. An example I can give that sort of pulls it together is I used to work for the Federal Housing Finance Board, and we ran interest rate stress tests on federal home loan banks. There were 12 federal home loan banks that were organized in the 1930s along the lines of the Federal Reserve System to provide liquidity funding to mortgage funding institutions that might not have access to the Federal Reserve. So the structure is quite similar. The business model for the 12 banks is in principle identical. They just have different regional territories that they operate in. And what we found is doing the interest rate stress test, we were doing very simple parallel yield curve shocks and asking them to revalue the full book. 12 banks with the identical business model had wildly different interest rate exposures. Some were long duration caps, some were short, some were inverted. It was just all over the place, and that's the sort of thing that you would have a really difficult time getting through an expert examination process.
Sure. So I'm kind of interested to see what, I guess, what collective dimension there is in terms of scenarios, right? So, you know, there are the regulators that are kind of thinking of scenarios, but, you know, it would be quite interesting to think about, you know, are there ways that you can, for example, issue challenges where, you know, there's a community that's constantly thinking of tail risks to actually come up with new interesting scenarios. That's the first thing. So sort of this collaborative dimension to stress testing, I think, is interesting. And then the second part is what do you do with that stress information, right? So there's right now it seems like that it's a regulatory process. You have to do it, and factors into capital. That's important. But can you do something to use this information for making decisions? Kind of like Marwa mentioned, looking at early warning signals, for example, connecting scenarios with actions, with potential actions, and as well looking at scenarios then from a network perspective as well. Are we looking at a bunch of scenarios that are really very closely connected? Are we forgetting certain spaces? Are there certain data gaps, for example, blind spots that we haven't addressed? And how has that moved? So how can we connect sort of network perspectives as well to this? So those are all kinds of things that I just wanted to throw out to see if anyone had any thoughts on or ideas.
You need to pick a minimal standing tree.
I think in terms of the scenario development, I mean, going back to the point I was making, I think it has to be at industry level, because arguably that's where those, you know, different risk factors develop and impact your particular set of clients within an industry framework. So some will be more relevant, like, you know, it might be a broader risk, like, you know, what does the current oil price situation mean for various industries, and then you kind of stress test your portfolio and look at, I don't know, EBITDA impact or leverage impact, and then kind of start taking that step down to looking at risk rating implications and hence how much capital you need to set aside. So my personal view is it kind of needs to be more industry focused, and most banks tend to break up their portfolios by industry, on industry lines, so that should be fairly straightforward to implement. The problem is how do you then kind of aggregate all that data? You know, one of the few virtues, well, from my opinion at least, the few virtues of the broader macro regulatory enforced stress test is at least, you know, it turns out a number in the end. This is how much extra capital you need to set aside as an institution, and that's kind of the action point, so to speak. But with those kind of disparate stress tests at industry level, it's very difficult to then aggregate that information. Unless if it's an internal initiative where the chief risk officer kind of, you know, every quarter says, right, all different industry risk managers need to aggregate this data, come present it to me in a roundtable discussion or something, and then action plans to be taken. That's just personal view.
Right. Or even tagging scenarios with, once you assign probabilities, right, then you can use sort of big data processes, right, like the friend who works at Facebook, they look at fast movers, right? Shouldn't banks look at fast movers in their portfolios and then design stress scenarios around that?
Well, I would have thought the minimum you should do is take a minimum spanning tree and take the node with the biggest number of links and attack that.
Yeah.
Network resilience, you know, internet, that sort of stuff.
Absolutely. That's a great network for a stress test, yeah.
For me, that's the horizon past the stabilized stress testing as a state of the art, because I come back to the beginning, and it's a nice conclusion. I think banks still need to get there, but where they can efficiently run stress tests, they're still not there. For many institutions, now is how do we do the stress test that is there, rather than what do we stress and what is the scenarios.
I think this is a very
But it's a very, the most interesting question is what happens in the different scenarios. How do we define also managerial risk scenarios, the ones that businesses understand and actually would subscribe to and see the results to. I think this is the interesting part. unfortunately, I think we're still away.
Any questions? I'd like to thank. Sorry, this one first.
A very simple one that comes out of complete ignorance. So the regulator gives everyone a scenario in which to run their stress tests, and then takes a look at the individual answers that comes back and says unit or capital, you're right. Does anyone know if the regulator then pulls those together and puts it into his network model and understands how strong or fragile the network of financial institutions in his area is? Is that dreaming?
So it's not dreaming. It's not being done currently, as far as I know, but it's under discussion. It's a more complicated exercise. The first round in the U.S., the SCAP, they ran the stress test on the bank's systems, and we've now graduated to a framework where the Fed is running them in parallel on its own systems to double check things. One of the ambitions is to get to a point where they can do network tests.
On that note, I'd like to thank the panel very much for the contribution.
I know Alex has got to go. Run straight off.